Welcome back to part 2 of our FICA series under the RE5 Visual Learning Program by RE Mastery. Remember, this lesson is here to enhance your learning, not replace your official study guide. In this video, we dive deeper into the practical obligations that FICA places on accountable institutions. Remember in part 1 we mentioned that in order to combat money laundering, terrorism financing, and other related crimes, FICA has placed several duties on accountable institutions. Now let us look into these duties one by one. Under the Financial Intelligence Center Act, accountable institutions have 4 main duties. 1. Customer due diligence. This means identifying and verifying the identity of a client before establishing a business relationship or concluding a single transaction. In a real-life scenario, this includes obtaining proof of identity, address, and understanding the nature of the client's business. 2. The keeping of records. An accountable institution must keep the records which relate to the establishment of a business relationship for at least 5 years from the date on which the business relationship is terminated. And an accountable institution must keep the records which relate to a transaction which is concluded for at least 5 years from the date on which transaction is concluded. Records may be kept in electronic format, but must be capable of being reproduced in a legible format. 3. Providing the Financial Intelligence Center, FIC, with access to information. Institutions must make information available to the FIC whenever requested. This allows the FIC to monitor and analyze financial activity for any signs of money laundering or terrorist financing. 4. Reporting certain transactions. Accountable institutions must report specific types of transactions to the FIC. A. Suspicious and unusual transactions. If a transaction raises concern about possible money laundering or terrorist financing, it must be reported to the FIC as soon as possible, but not later than 15 days after becoming aware of facts giving rise to suspicion. The 15 days excludes Saturdays, Sundays, and public holidays. B. Cash threshold. Reports, cash transactions above 49,999 Rand and 99 cents must be reported. Whether as a single amount or split into smaller linked amounts must be reported. These must be reported as soon as possible, but not later than 3 days after becoming aware of the transaction. C. Terrorist property reports. If you suspect property is linked to terrorist financing, it must be reported to the FIC. In simple terms, if money, assets, or property seem connected to terrorism, report it. These must be reported as soon as possible, but not later than 5 days after establishing that terrorist property is held. These 3 reports, STR, CTR, TPR, are the backbone of reporting under FICA. Forgetting them in the exam can cost you marks. Another important concept is the tipping off prohibition. An accountable institution may not inform a client that a report has been or will be filed. In simple terms, once you report, it stays confidential. You can't warn the client. Moreover, every accountable institution must have a risk management and compliance program, RMCP. The RMCP outlines how the institution identifies, monitors, and manages the risk of money laundering and terrorist financing. It also includes processes for client identification, record keeping, and reporting. In simpler terms, it's an institution's written plan for applying FICA's rules in daily operations to stay compliant and prevent financial crimes. Question 1. James was previously a representative of a large insurer. He has left to open his own insurance brokerage, which is classified as an accountable institution. He approaches you for advice on the records he has to keep in terms of the Financial Intelligence Center Act. Which of the following are among them? 1. Documents used to identify and verify clients. 2. Records of complaints received. 3. Records of all transactions. 4. Records of known premature cancellations. Options: A. 1 and 2, B. 1 and 3, C. 1 and 4, D. 2 and 3. Answer: B. 1 and 3. These are specified record-keeping duties according to FICA, along with the manner in which the identity was verified, the person at the institution that identified the client, and the nature of the transaction. Question 2. A client deposits cash in the amount of 49,999 Rand and 99 cents into their investment account. In terms of the Financial Intelligence Center Act, which of the following is correct? A. The transaction must be reported as a cash threshold report, CTR. B. The transaction does not trigger a CTR, as it is not above 49,999 Rand and 99 cents. C. The transaction must always be reported as a suspicious transaction report, STR. D. The transaction only needs to be reported if it is requested by the Financial Intelligence Center. Correct answer, B. An amount of 49,999 Rand and 99 cents is just below the threshold and therefore not reportable as a CTR. Remember, we only report if it is above 49,999 Rand and 99 cents. However, if the transaction appears suspicious for other reasons, it could still require an STR. Thanks for watching. Don't forget to like, share, and subscribe. And be on the watch out for Part 3.